Nancy, we're still talking about a correction, especially when it comes to tech stocks. The NASDAQ 100 could close down for a fifth week in a row, the longest losing streak going back to May of 2022. Is this correction a sign of more weakness to come, or do you think we're at the bottom?
Look, I think near-term forecasting is pretty nigh on impossible. But one of the things to keep in mind is we have a pretty big D-Day deadline ahead, which is April 2nd. And until we know what these tariffs are, the magnitude, reciprocal, et cetera, I think markets are going to be pretty volatile here. But look, we think this is a correction and not the beginnings of a bear market because we don't see a recession. And I think that's an important thing to keep in mind. We were overdue a correction. Corrections normally resolve themselves, the markets move higher, huge levels of pessimism, which I find very encouraging. But we could have some volatility here, as you mentioned, for at least another 11 days.
What makes you so sure that we're not going to see a recession? The consumer, we know, powers this economy. We've gotten some mixed consumer data, especially in the early part of last week when it comes to airlines. What makes you so sure we're not headed toward a recession?
Well, first of all, I think it's the dichotomy between the hard and the soft data. So the soft data has been weaker. Consumer sentiment, inflation expectations 1 year have risen. And we do think that the economy is slowing, certainly going to be negative probably in the first quarter because we had all that buying of imports proactively by companies, which is meaning that net trade is going to be a negative. So expect the first quarter to be lower, expect GDP overall for 2025 to be weaker than expectations. But, let's get back to the hard data. Jobs, personal incomes, the household balance sheet, which was announced by the Fed 2 weeks ago, still remains pretty strong. And what we haven't talked about the fact it could well be that investment surprises. Look, you saw NVIDIA committing to $500 billion over the next 4 years. That comes on top of Apple. That comes on top of TSMC. Add those three companies together, and you're looking at close to $1.4 trillion of expenditure over the next 4 years back into the United States. Not to mention the funding bill making its way through Congress, which might have some CapEx goodies like 100% expensing of R&D and depreciation, et cetera. So there are some things here. Hard data is still solid, though slowing. And we think there are some things that will come in what I call the goodie side of Trump that are still to come.
Let's zero in a little bit on tech, specifically the Mag 7. Meta Platforms is actually higher for the year as of now, but for the first time this year, it did dip into negative territory for the year. Other than that, 6 of the 7 Mag 7 are negative on the year. Do you see a turnaround with the Mag 7?
Well, we don't buy stocks, we buy managers, but our managers have been underweight. Our active managers are underweight the Mag 7. So that's been a good positioning for us this year. Meta's done a much better job, I think, of communicating how they expect all this AI spend to result in better metrics, advertising metrics, engagement, et cetera. The other companies have been a little bit more vague. And that's why investors are concerned, at least for the 4 horsemen that are spending, $320 billion plus, on various forms of AI infrastructure, how that's going to result in returns. Our view, let's go to the spending beneficiaries. So we like digital infrastructure. We like infrastructure generally because that's where all the spending is going. We like power. We like energy. We like onshoring of production. We think infrastructure is something that's less correlated to equity markets, very, very good counterparties, but also is part of what I call this huge spending surge that's likely to continue. So Mag 7 underweight. We think that's the right positioning, but we want to be with the spending beneficiaries.
What's your view on how Gen AI adoption moves to other parts of the market? So far, the beneficiaries have largely been the hyperscalers, the chip manufacturers, the companies that we talk about each and every day. When does that move beyond these companies?
So our theme has been a broadening in market participation. And by the way, we're seeing that this year. It feels horrible, but 97% of the decline is coming from the Mag 7. There are a bunch of sectors that are in positive territory. But looking forward, and of course, European markets, the Chinese markets in positive territory as well. So, as we look forward, we think that broadening theme will be operative, that we think Gen AI is early innings, right? Compute power is going to come down. These large language models are going to come down, the cost of that. And of course, that's Jevons paradox that leads to greater adoption. And that's not been priced in. The profitability and productivity enhancements across large sections of the global economy from Gen AI is still to come. And that's really not priced in. And so, again, that's not a tomorrow thing, but we think that is positive yearly from the kind of a medium-term perspective. And again, our clients are longer-term, investors. We don't try to play the markets with a day-to-day trading mentality.